So I want to talk about constructing a straddle, and this is going to be part one of a three-part series. Today, what I want to discuss with you is the basics of a straddle, and then we'll talk about one of the ways you can use as an entry feature for straddles, and those of you that are technical traders, you're really going to like this. So let's talk about the basics, and let's talk about what this looks like when you put it together on a risk graph. So first of all, straddles are a delta neutral strategy. That means I'm neither bullish nor bearish. I'm a little bit of both, all right? And so we use straddles to understand how to make money without forecasting market direction. The other thing we're doing is we're offsetting what's called positive and negative deltas. So those of you that are option traders that understand, may understand a little bit about Greeks, then you understand that there are positive deltas with certain option strategies. There are negative deltas with certain option strategies. And delta neutral means we're putting this all together. All right, we're putting this all together to create a delta neutral strategy. It involves buying for every call option you buy. And this is an at the money call. You're also going to buy an at the money put. Okay, the deltas will offset themselves when you use both. We're also going to be looking at a straddle has to have the same strike price and the same expiration month. That's what gives the straddle its nature. All right. So for part of this, we're looking at the call option part. Okay. Now, long calls on their own are bullish. You buy a call option. That means you have the right to buy a stock, and you have that right for X amount of time. If you're looking at the call option on its own, it has limited risk. It has what we call unlimited potential, meaning we don't know what the upside, there's an open upside there, right? And you take a look at, for instance, what's happened with the markets here today with this big jump in the markets. It does kind of lend its way toward, well, where's that individual stock likely to go? If you're buying a call, you have unlimited upside until you take that trade off or exit it. The put's completely the opposite. It's a bearish opportunity. You have the right to sell a stock at a predetermined price for a predetermined amount of time. That has unlimited potential to the downside until you hit zero. And it does also come with limited risk. A straddles risk graph is when you put the two together. You buy the call and you buy the put. And by doing that, you've created this bi-directional, this particular trade that works in both directions. You might be, if you're looking at this for the very first time, you might be seeing, Tom, this is it. This is the only thing I need to know. I didn't know I couldn't do this. I didn't know that I could put a trade on regardless of market direction and make money. Well, it comes with a catch, right? So you need to understand that the part that is risk, there are three types of straddle risk here. Number one, there's time decay or theta risk. What that means is that if the stock, you're buying a call and you're buying a put, that means you're paying twice as much money as you would to buy one or the other. That means you also have twice as much risk on the trade. That's what you're paying for when you want to trade non-directionally. You're double paying. And because you're double paying, you have time decay, this is the greatest time decay trade that's out there. Buying an at the money call and an at the money put, because you've got time decay on both sides. The options can and will drop in value. They'll drop their time. Now, the other thing is Vega risk, and that's when you buy options that are overpriced. And so, when I'm looking at like the Qs and I'm looking at the SPY right now in the markets, I believe they're overpriced. So that's Vega risk. And then you've got delta risk. And delta risk is where the stock just simply doesn't get up and move anywhere. In order for a straddle to make money, a couple things have to happen. You have to either buy it cheap. You got to be buying it as it's going, as the time premiums increase and the Vega risk is going up, because somebody on the other side and the collective option traders believe that the options, that straddle is undervalued. Or the other way you make money is the stock rockets out, all right, farther than the cost of the straddle. So how do they get profitable then? Well, exactly that. The price goes up where the calls make more money than the puts lose. The price could go down where the puts make more money than the calls lose. Or, like I said before, option prices get more expensive overall. That means the implied volatility increases. both the puts and the calls gain value, even if stock price doesn't move. Now, the best way that happens is when we come upon earnings season, right? But we're not going to talk about that today because very few stocks have earnings. The heavy hitters all happen next month. So let's talk about the first two. The price goes up or the price goes down. Price goes up more than the straddle's worth, or the price goes down more than the straddle's worth, and how we can find something like that. So here are 3 chart patterns, right? This is patterns of profits. Here are 3 chart patterns that work with a straddle, right? No, they don't work 100% of the time. Nothing does. But these are good repeatable patterns that you can use. So the first one I find is the most popular among traders that like to buy calls and puts together, straddles, when they have no clue where that stock or that asset in question is likely to go. It's called a symmetric triangle. That's where you have lower highs. All right, the highs get lower and the lows get higher. Now you also find ascending triangles, and that's when you have same highs. That means you're hitting resistance, but support is climbing. And then you have descending triangles where that resistance is dropping, but support is holding steady. All 3 of these have points at them where the breakout of these is imminent. The question is the breakout going to lead to a big momentum trade or a fizzle, right? So we look for them to become a big momentum trade. So putting these together, all right, here's an example of a stock right now that has a descending triangle. And it happens to be Tesla. So take a look at Tesla. Tesla has support right down here in the 380s. But Tesla over this year has dropped from 500 to the high of 450, to a high of 430, to a high of 425, to now we're down into the low 4s. So what's happening? We have resistance dropping. We have support holding steady. We have a triangle that's occurring. And so based on nothing else except the chart, let's construct a straddle with this trade. So I want to construct a straddle using the hub options data and the hub platform, and I want to use Tesla as an example. How do I create a straddle? Well, what I'm going to do is I'm going to pop in, and here's my chart, and I can see right away that as I'm looking at this, there's that descending triangle that, looking at an area where we might see an area on the chart that might make a move, right? So from here, I'm going to go and I'm going to click on the options tab, which is down here at the bottom left-hand corner. I'm going to open that up. Now, most straddles I like to look at are, that 60-day roughly opportunity. So that's going to put us around mid-May. So here's my mid-May options. And I'm going to run, I don't need to run too many strikes because all I need to look at is where those at-the-money calls and puts are. Here's my at-the-money call options on the left, the 375, 380s. And here's my at-the-money puts on the right. Again, 375, 380. The easiest way to do this is right up here. You see this select strategy? We can select the straddle. And that's what I'm going to do. I'm going to click on straddle. And it's immediately going to create a straddle for me using the data that I've just collected. All right, so right here, I have the 380 call, all right, for May, mid-May, and the 380 put for mid-May. And if I come over here to the right-hand side, I can see exactly what this is constructing for me. It's saying, right now, the 380 call for May is mid-pricing just under 22, and the 380 put for May is mid-pricing just around 31.75. So putting these two together, this straddle is going to cost $5,368. Remember what I said. This is the most expensive strategy you're going to find in options. But when you got a stock, this is good for 100 shares of stock, both long or short, the right to buy, the right to sell. Because you have the right to buy and the right to sell, that's why it's costing you this much money. But you're putting this on a stock that's trading in the 380s. So here, I want to see what this looks like on a risk graph. So popping the risk graph up, it looks like this. So I'm going to move the graph. I'm going to move this up a bit, And there's your straddle to the right. The straddle shows me that it shows me a couple things. It shows me where my break-evens are. All right. Here's my break-evens, the dotted lines. All right. These dotted lines show me where my break-evens are on one side or the other based on how much this is going to cost me. Right. Take that $5,368. You're going to add that to that $53.68. You're going to add that to the call, the straddle, and you're going to subtract it from the straddle, and it's going to give you those break evens at expiration. It also shows me what has to happen with this stock in order to see profitability. Right. And when I'm looking at it right now, it shows me this. Shows me that, you know, if Tesla were to break out and quickly move back up into the mid fours, it's going to show me profits over here of, you know, something considerable. Or if we drop down to new lows, you know, we drop down into 300, then you can expect to see something that's going to be close to a double. So up here in the mid to high fours, profitable. Below, you know, in the threes, profitable. Or something could happen today, jumped up 25 points or jumped down 25 points, and the calls might move higher than the puts lose, or the puts might move higher in price than the calls lose. But that's the basis of putting a straddle together. All right. Any questions, folks, that you have on straddles? Happy to discuss it. Now, this is a three-part series, so what I plan on doing is over the next few weeks, I want to show you a couple other ways that you can get into straddles. Today, I wanted to talk about just about price point, you know, looking for those price points, like those triangles. You know, another one, if you haven't noticed it, I have Bollinger Bands on here. Now, I've said this before. I'll say it again. I'm not a fan of squiggly lines. Squiggly lines don't help me in terms of whether a stock's going to go higher or lower, but squiggly lines, when I put standard deviation bands, that's what Bollinger Bands basically are, is I look at the range of the stock and I look at the squeeze of those bands. I like to look at that squeeze and I like to get an idea. Let me turn some things off here. I'll take implied volatility off and we'll just be looking at the chart itself. See the bands, how wide they get over here? It just shows me we've got breakout. And when the bands get consolidated, it tells me price is consolidation and there could be an impending breakout happening. And so, you know, we look for that squeeze to happen as well. That's a way of measuring volatility. It's a way of measuring what we call statistical volatility. All right. So that's not a squiggly line in the sense that I think the stock's going to go higher or lower. These particular lines give me an idea if a breakout is pending. It's another way of looking for consolidating markets.